Rahul Chadha, Co-Chief Investment Officer at Mirae Asset Global Investments, joins us right now on the show. Rahul, good having you. Thanks much for taking the time out. This is Neeraj here. Good morning. Not specifically a call on Yes Bank, but the fact that we've seen an issue like this come up wherein there is kitchen sinking in what was arguably a better corporate-facing bank, coupled with all the stress around the debt papers in India, which has now come up post-Friday with the downgrades that have come in for a couple of papers. What do you think happens to sentiment in the near term? Does the street get even more polarized towards quality at the expense of some of these companies which will be left to hang dry?
Yeah, I think clearly there's going to be a bias towards quality, and we've seen that play out over the last 6-9 months, specifically for Yes Bank. I think everybody knew that lending was risky lending, more of a high fee lending, and because over the years they're not provided for, so we thought that things are well and good, but as we saw this kitchen sinking, I think the mood's gone to the other extreme. So it's going to be a couple of quarters before market gains the confidence. And in the interim, what market do is look at names like Axis ICICI, where the belief is that bulk of the provision for NPAs is behind us.
So Rahul, what would I'm just trying to think as to how would an investor, for example, an investor like you think, would you say that let's assume you get large fresh money to work. Would you selectively choose some of the distress within the financial space right now, or because it's so difficult to predict as to what's the quantum of distress or what the quantum of cockroaches that will come out when this whole kitchen sinking exercise is on, whether in a book like Yes or whether in some of the other paper companies wherein the debt maturities and the ability to repay is unknown right now, that let's just leave them alone. It doesn't matter. We are in no rush to buy them. Maybe the idea to buy them would be when it shows in the print and you buy them maybe 20-30% higher, but with certainty. And for now, if you want an exposure to Indian real estate or Indian finance, go in for the expensive ones because the growth will be there.
Okay. So if you look at current gain, our India funds, financials would be close to 35% of the fund, and large part of the portfolio would be HDFC Group, which is high quality lending. Outside that, you look at ICICI Access. Again, both these names have just recently finished recognition of the NPAs, so you have an upcycle which comes through. There will be positive surprise on earnings. So one would look at these names over NBFCs. One would look at these names over other corporate banks where the asset quality recognition is just done. Something we've liked a lot is insurance, and we've seen early signs of turnaround in numbers. Quarterly premiums picked up. You've seen the move towards protection. There is a hugely underinsured market from a protection perspective, and protection is a highly profitable business. I think there is deep value in insurance. So there are pockets of opportunity in financial. And like the way you rightly said, there is no hurry to look at some of these names because there is never one cockroach in the fund. And right now what we've seen is initially there was denial. Right now there is some bit of an admission that there are some issues in the book. But look, it always requires more than 1 quarter for things to clean up. And one doesn't know the collateral damage which would happen that if one of the NBFCs come under pressure, a lot of these guys were lending to the same set of groups. So what happens to other banks or other NBFCs?
Actually, stretching this discussion just a little bit, Rahul, that would have been my next question to you. There was this Credit Suisse note which spoke about the repayments that NBFCs owe to mutual funds over the course of the next 3 to 6 months. I don't know if you have a chance to look at it or no, but the numbers range from 1.3 lakh crores in the next 3 months to much higher number over the course of the next 6 months. Now, my question is, in wave 1, which happened post IL&FS, some of these NBFCs were able to sell good quality assets and meet these repayment obligations. Wave 2, which might come now, maybe the good assets are not there with select NBFCs. Do you reckon the situation can be so dire that there will be big time consolidation, selling off of NBFCs at much lower prices as well, because the existence will be very, very difficult because there are no assets to sell to meet the repayment obligations?
No, absolutely. I think what would happen is there would be people would be looking at the good parts of the book, and for good NBFCs, there would be takers, but those takers would come closer to the book value or probably a small premium to the book, but the huge premium these guys traded at is a thing of past. And for the guys who have questionable book, one doesn't know how that gets sorted out. The only hope there is that hopefully government doesn't call the big public sector banks to bail them out, because then that would be negative for the system.
Rahul, good morning. Devina here. I want to switch topics now from the NBFC pocket to what's been happening within auto as a space as well. We've seen numbers coming out from Maruti. We've seen numbers coming out from Hero MotoCorp. Expectation was that they will see margin pressure, which has actually culminated. The other point being Maruti hinting the fact that they're actually not going to, look at diesel cars in a big way, and only if at all there is customer demand will they look at introducing the BS6 version diesel engine cars. Do you see this, as a big game changer within the auto industry?
No, absolutely. I think a big, broader issue for the auto industries, and which one is seeing in China, one is seeing globally, is that look, the demand shrunk because of ride sharing, because millennials are not buying those many cars. And particularly in India, we saw auto companies traded a huge premium to their global peers. So some of and on high operating margins. So both these things are getting corrected. You're seeing margins which are getting normalized. You're seeing multiples which are getting corrected. And look, all these down cycles are never a quarter or two down cycles. At least last into 2-3 years. And then there is this disruption which is coming from, the punitive cost which come in form of adhering your diesel engines to the new environmental norms. So I think that's where Maruti can walk away from diesel, but I think it's got bigger ramifications for the rest of the industry, which has a fortune tied to diesel, basically.
Do you think it's going to be a struggle for the industry, be it passenger vehicles or be it the two-wheelers, for a considerably long period of time? Because, so far we've really not seen an uptick in terms of overall volumes, and the management guidance also for growth has been tempered.
Okay, so I think it's going to be a struggle for about a year or two. If you look at the struggle, it started from August, September of last year. Give it about 2 years, because the product prices, because of the new emission norms, have gone up anywhere between 10-15%. So in 2 years, looking at an annual inflation of 5-7%, the consumer would reconcile to it, and then there's going to be a pent-up demand. I think the game changer could be if government introduces any scrappage norms for old vehicles, particularly cars, etc. And there's incentives for people to upgrade their cars or commercial vehicles. So that can be the differentiator here. I think that's being talked about in China also. But that can get front end some of this part. Else, it's going to be 2-year cycle.
So, when we're looking at the earnings picture right now, it doesn't seem like there is much that's happening on that count, aside from IT, which is slightly better off compared to the other big ones that have reported numbers. What's your sense on whether or not an expectation of about 15+% in terms of earnings growth is achievable by FY20, or that could be questioned as well, considering a slightly longer period of time for earnings recovery?
Okay. See, I think the earnings growth can be achieved, but the problem would be that the earnings growth would not be broad-based. This earnings growth would be achieved because some of the heavyweights like corporate banks turn around, like SBI, ICICI Bank, etc. Tech should grow in line with expectations, anywhere 8-10% earnings growth. But outside that, if you look at parts of consumers, with either the staples or the consumer discretionaries like auto, they would be better struggle. So ideally, from a longer-term health of the market, you would want this earnings growth to be broad-based. But I think over the next 3 to 4 quarters, it's going to be a narrow set of companies which are going to be driving this upgrade in earnings.
Rahul, we're seeing some green shoots of growth in select, industrial-facing or capex-facing sectors. Cement seems to have seems to be showing some signs of growth, 70% odd utilization levels by a couple of companies, and margin expansion shown by Orient Cement right now, but Ultratech numbers looked okay too. Is there merit in selectively being bullish on cement, or can this be deceptive as it has been in the recent past?
I think it's a promising sector, and we are overweight cement in our India funds. If you look at last 6 9 months, demand's been a healthy double-digit growth. We're seeing uptick of demand from rural housing, infrastructure, etc. Hopefully, post-elections, kind of an urban housing should also pick up. Affordability is the best it's been in last 10 years, and with all this government talk on infrastructure getting a further boost, that should be positive from a cement kind of a demand supply perspective. I think the key thing for cement would be whether the ruling party gets voted back. So if we have political stability, that would get the much needed investment demand in place. And that's really going to be the key call for the sector.
Okay. Wondering if you believe that it is too early to bet on some of the others. I know enough and more smart money, which is saying that it's a great time to get into power. It's a great time to get into capital goods as well. Somehow, the earnings aren't quite showing that.
Yeah, no, I think we find valuations for some of the capital goods companies expensive at this point of time outside the leading company, L&T. Again, the risk reward is not favorable. One would look at some of the power utilities where you'll see benefits of uptake of demand, where you've seen the benefits of PLF improving being played out. So that's something one would go. And from an investment cycle recovery, I think it would be largely cement and L&T to play out.
So you would leave power out of the equation as well? Valuations might be compelling.
Yeah, see, power, when I say it would be largely through the leading power utility, NTPC, etc., one would be playing the demand revival, but not from capital equipment, not from the equipment makers.
Okay, so just to get this clarity straight, you are leaving out the generators completely, the Tata Powers, Adani Powers, etc. Despite the resolutions and all of that, and no new capacity is getting added, there are things which worry you for not to go out and take a bet on them, right?
Yeah, obviously there may be some governance issues here and there. So there may be near-term triggers because of these old PPAs being sorted out, but we're more comfortable with the stable names.
Rahul, so far when we're looking at the individual pockets as well and the commentary that we're getting in from various market participants, the only positive that we hear is corporate facing banks. There's nothing that has come out in a big way aside from this pocket, which is going to be the earnings growth driver, which is going to probably yield good returns for investors in the near term. Everything else has a tinge of grey to it. Do you also fall in line with consensus, or there is any contrarian view that you have as to what could be a leader of growth, probably not even a leader, but just align itself to the overall growth momentum in the near term?
Okay, so apart from corporate banks, again, insurance was something I said we like. Cement is something we like. One can look at OMCs. Again, they're priced for extreme pessimistic scenarios, so hopefully things improve. And then some utilities, gas utilities, power utilities, where you have to support. And I think in 6 months from now, once we have a stable government, you see signs of investment cycle picking up. You'll have a lot more names coming. Right now, things are so binary that, look, if the outcome is not favorable on elections front or in the demand revival front, one can have significant downside in some of the investment cycles.
So can you dwell a little bit more on the oil marketing companies and why do you think that there could be some more interest there? Because obviously right now, considering it's election period, they're not allowed to take any kind of pricing hikes. You've seen crude oil reaching year high levels, though it's come off a bit yet. But Q1 of FY20 is going to be a period of a drag for them, keeping all these factors in mind. So what is it that you exactly like for the oil marketing pack?
Yeah, so basically these companies are monopolies. They're trading at around 1.2 times book. If you look at their average ROEs, ROE's been around 15%. I get your point that there would be periods where they're not able to fully pass on the crude price hikes. But our base case view is crude doesn't go beyond $80 on a sustainable basis. So then the pain period is limited for these companies. If you see over the last 6-9 months, they've managed to pass on all the fuel price hikes to the end consumer. So overall, from a business perspective, they look decent. And then again, our point is, you look at other pockets of growth in the economy; those are limited. There's so many businesses which are getting impacted by disruption. Here, at least in India, your fuel demand is growing at 5-6%. So that disruption impact is limited in near term.
By the way, just want to mark that Yes Bank, of course, stays lower 25%, but a clutch of other names stay lower too. The ADAG pack, Reliance Power, Reliance Infrastructure, sure, Reliance Capital falls in that bucket too, Reliance Naval. All of those stocks are correcting and staying lower today. Everready is down about 10%. Keep that at the back of your mind. Diwan Housing, 7.5%. Indiabulls Real Estate, 6.5%. And Jet Airways too is facing some pressure today, down about 4.5 to 5%. So seriously, some pressure on some of these usual suspects in the session today. The Nifty may not be down too much, but the Nifty Bank, courtesy Yes Bank, down nearly 1%.
Yeah, it's definitely blood on the street for Yes Bank and the rest of the banking pack as collateral damage from what's been happening to Yes Bank at 179 right now. Rahul, just to, one last question from my end, and some contrarian calls on telecom as a pocket. We've seen a few numbers come out. We've seen Jio, we've seen Bharti Infratel. Obviously, three big players remain in this industry, and FY20 is the year that you're actually going to see anything meaningfully improve for the industry as a whole, and growth starts to kick in. Would you preempt that and be an investor in telecom right now?
Okay. Now, I think it's an attractive price level from a bottom fishing perspective. Where one has a fair bit of a difficulty is to understand when does Jio backs off on this price war gain, because market here is watching the quarterly traction in revenues. As you see revenue momentum pick up, I think these stocks are going to trade up. And look, from a market structure perspective, this is a perfect market structure. Between three of them, they're controlling close to 90% of the market. The data growth rates are in excess of 30-40%. So this is a market one would like to be invested in. It's really a question of when does Jio kind of backs off and becomes a rational competitor in the market.